DraftKings investors striking out. The sports betting stock under pressure today as the Major League Baseball lockout gets uglier. MLB delaying opening day and canceling its first two series games of the season as players and owners continue to lock heads over a new deal. DraftKings is an official sports betting partner of the MLB. Let's bring in Oppenheimer Executive Director and Senior Internet Analyst Jed Kelly. He covers DraftKings with an outperform rating on the stock. Jed, great to have you with us.
Thanks for having me.
I'm sure the actual cancellation of just the two games isn't the impact here. There are a lot of other ripple effects in terms of customer acquisition and just sort of keeping consumers engaged with the app.
Yeah, I mean, I think when you look at it, it's very transitory. I think last year, baseball accounted for 7% of overall GGR. So it's very small. It's probably less than 2 to 3% of DraftKings revenue, and it's still early, right? The owners and the players are still negotiating. You get a good outcome. You could see an April 7th start. You have to keep in mind, I think, with the TV deals, the owners don't have to rebate their local networks until 25 games. So even if it starts out even early May, you'll still have the NHL and the NBA playoffs and the Masters to sort of offset some of that. But it gets more interesting as we get into probably after Memorial Day.
Jed, when you look at these, they all sort of trade similar. If I look at Bally's, it's down 9% year to date. DraftKings was down coming into this. Is it binary where before the pandemic they were doing well, then the games were off the board, and now when MLB gets back on, it's going to rally again? How do we look at these?
No, I'll be honest with you. I don't think pauses of games are that big of a driver of the stock. It's more on two things. It's more on regulation. It's more on customer acquisition, right? If you had shorted DraftKings after Governor Cuomo came out with a 50% tax rate for New York State, you would have made a lot of money. Like, that's when it drove down the stock in early April, right? So that's number one. That's the big driver. Number two is just the customer acquisition intensity. What we've seen in the last 3 weeks, we've seen DraftKings rally. Why is that? They missed their quarter. So what's happened? You've had MGM come out, say, "Oh, we're stopping, or we're gonna alleviate our spending." Caesar said the same thing. FanDuel said they're going to continue to spend aggressively. So it looks like we have, going out to the next year, we're going to have a two-horse race with aggressive customer acquisition between DraftKings and FanDuel.
So what are you expecting from the Investor Day tomorrow? What do you want to hear more about? Because it sounds like you're saying that this is a story of just it being able to ease off on the spending to acquire customers. That doesn't really sound like a sustainable business model.
Well, I mean, what we want to hear and what they're going to talk about is their cohort states. They're going to try to show how New Jersey, their 2018 or 2019 cohort, is contribution profit. It's profitable, right? Because what they are seeing is they are claiming they are seeing attractive LTV to CACs to justify the spending. You look at the market growth. New Jersey last month, its handle still grew 36%, even with New York Live. So they can make the case we can justify the spending. We're still real early in the market, so I expect the spending to continue. You look at DraftKings and you look at FanDuel, they're both well capitalized. And if California goes legal here at the end of the year, you're going to see more spend. So the spending's not going to stop. It's going to be, how do you message to investors that these states we've been in since 2018, 2019 are starting to turn profitable? And if you look at the UK, the leading players in the UK are all generating 20% EBITDA margins.
What's that new metric that they came up with, Jed, out of the last earnings season in terms of backing out what they spend on customer to figure out how profitable it is?
Contribution profit. It's basically gross profit less your direct marketing.
Yeah. Okay. Jed, thank you. Jed Kelly.
Thanks for
Tim Seymour, you've been in this one. What do you think?
I have been, and I can't start talking about DraftKings in relation to a baseball strike without leaning on Rob Manfred. I mean, what an atrocity this has been, and we could be in a different place. But DraftKings, I think, as Jed pointed out, a supply disruption or a baseball disruption is not a reason to sell this stock. I think some of the dynamics around the spend and the competitive landscape have absolutely been the pressure on any of the names that have exposure here. The fact that DraftKings is also part structure-wise of the SPAC world, where I think as a strategy, we've seen a lot of these SPACs and people have gone after them in the same way that these were seemingly free money on the way up. And I think that's some of it. I think we've sorted through some of those liquidity and kind of technical dynamics, but I think the story is a land grab. The story is about where the addressable market grows. And it's tough to get excited about that in a rising rate environment where high multiple stocks get beaten. But again, the top line is growing, and they are increasing market share, and there is a linear relationship between ad spend and market share.
True. So every customer comes at a cost, basically, right? Guy, can you get on board at this point, knowing that, it's blue sky in terms of the market at this point, with states opening up, every month, every week?
Yeah, I think Tim makes a good point about baseball. I mean, that's, that to me, that's a bit of a red herring. I don't think baseball's that huge a deal. They'll figure it out at some point. Question is, has it gotten to levels now where you can trade the stock from the long side? And I think the answer is probably yes, especially with Investor Day tomorrow. My sense is you'll probably hear pretty encouraging things, and competition seems to be waning a bit. By the way, I'd be remiss if I didn't point out that Jim Chanos has been one of the very vocal bears on this stock, and he's been spot on now for over a year and a half, 2 years. So, again, he's done extraordinary work, but I think it's at a level now where it might be worth a look on the long side.